Hey there, this is Seth, and today we're going to talk about the buyer's advantage when buying properties with seller financing. This is all about how to set up loans and loan terms in a way that is most advantageous for the buyer in this type of transaction. And I'm really excited to dive into this. If you can stick with me, and if you can process everything I'm trying to explain to you here, I think you'll have at least a few, if not several, light bulb moments. When you buy real estate with seller financing, there are all kinds of ways you can structure the terms of the deal so that you, as the buyer and borrower, have a deal that is highly advantageous for you with as many options as possible. Now, granted, you'll be somewhat limited by the seller in which options they're willing to give you, but by contrast, when you get a loan from a bank or a credit union or some other kind of conventional lender, you will absolutely not have this flexibility. There's not even a point in trying to negotiate the terms of your loan with them because that's just not how they work. When you borrow money from a bank or credit union, they will always use their boilerplate templates, which are written to give them the maximum amount of control and options. But with seller financing, there is much more opportunity to write the loan documents in a way that is fair to the seller, but also works to your advantage by giving you plenty of upsides and advantages. Your ability to negotiate these terms will depend on the seller's flexibility and what they need and how sophisticated they are and how much they're willing to entertain what you want. But in many cases, especially if you are the one proposing seller financing in the first place, and if they're willing to go along with that, and if you already have your own documents and deal structure well planned and ready to go, many sellers are not going to put up obstacles in the same way that a bank will. So I want to share several different terms you can infuse into your loan documents to give yourself the kinds of options and control that you would never be able to have with a bank loan. And just to be clear, I don't mean to imply that you should always push for all of the things I'm going to talk about here. In fact, it would be highly unlikely that you could get a seller to agree to all of these conditions we're going to talk about. My goal is just to help you see all the different cards you can play so that you can get creative and pull the right ones out of your back pocket when needed. When you understand the seller's wants and needs, you can fine-tune the terms to craft a deal that's going to work very well for you. Now, before we dive even deeper into this, I want to be perfectly clear that I'm not an attorney, I'm not a CPA, and nothing we're talking about here should be misconstrued as legal or financial advice. And many of the terms I will discuss here are not standard provisions in the boilerplate templates used by most title companies and attorneys. So if you go directly to your closing agent and tell them to draft your loan documents with these provisions in them, there's a good chance you're going to meet some kind of resistance, because some of the things we're going to talk about here may be things that they've never even seen or heard of before. They may even tell you it can't be done because it doesn't fit inside the neat little box that they're used to seeing. So if you choose to use any of these terms or conditions in your loan documents, your best course of action is to have your attorney draft them for you. Do not try to draft these documents on your own, and don't try to shoehorn these into whatever templates your title company may be using or whatever templates you find online. When you get your loan documents put together by your attorney, make arrangements to close the deal with your attorney or whatever title company they recommend. Make sure your closing agent is okay with using your tailored documents ahead of time so you don't run into resistance or confusion from them at the closing table. This is a critical time in the closing process, and it's not the time when you want to start hitting roadblocks. So make sure you get all this stuff teed up before you're actually sitting there at the closing table. So the first term you should know about as a buyer and a seller finance deal is called the first right of refusal to buy the note. And this may come as a surprise, but did you know that as the buyer/borrower, you can actually set up the loan documents so that you, as the borrower, have the option to buy your own note from the seller/lender. And not only that, you can buy it at a discount. So when I first heard about this, it kind of made my head spin, and I didn't realize borrowers could actually buy their own debt, but this really is a thing. And if you understand how and why you can use this, it can give you a huge advantage. When you include a first right of refusal to buy the note as a borrower, you can more directly control your financing terms. This means that if the seller ever wants to sell the note to another investor, and for many sellers, this is something they eventually want to do because they don't want to wait the full term of the loan to collect all their cash. When that day comes, they have to give you the first choice to purchase the note before they can offer it to anyone else. And if you choose to buy it, you can set it up so that they have to sell it to you at a discount from its current balance. So why exactly would a seller or lender agree to do this in the first place? Well, it's because if the lender ever decides to sell their note to anyone, whether it's to you or anyone else in the world, they'll almost certainly have to sell it at a discount anyway. Most notes sell at a maximum of about 80% of their current balance, even when everything is done right and everything looks great. But the exact discount depends on the specifics of the deal, so it's not unreasonable to ask for a discount. You're just asking them to give you the first shot at buying it before anyone else does. And honestly, if anything, this is just going to make the seller's life easier because they don't have to search high and low for a note buyer to cash them out. You could actually be doing them a huge favor by buying it from them directly and just making it a lot easier and faster for them. So what exactly would this mean? Well, if you buy your debt from the seller at a discount, you would effectively owe the money to yourself. And then once you owe the money to yourself, you can effectively wipe out the loan because you just paid it off through a backdoor method. And granted, you did do this at a cost, but the cost was less than the loan balance because remember, you bought that note at a discount. And by contrast, if you had just paid off the note the old-fashioned way by wiring the funds to your lender, you would have paid off the full balance without any discounts. So this clause can potentially save you a nice chunk of change. Now, another thing to put in your loan documents is regarding the rate and maturity. So did you know that in a seller finance deal, you don't necessarily need to pay off the loan with normal straight line amortization? This is where there's equal monthly payments over the entire term of the loan. Even though this is how most loans are structured, if you go to any bank, this is like the standard way that they'll do it. That doesn't mean you can't explore some alternatives with the seller. For example, what if you made a single payment on this loan each year instead of one payment per month? Or what if the seller allowed you to defer your payments for 12, 18, or 24 months just to give you a chance to get that property resold or improved or cash flowing or whatever it is you're planning to do with that property? Or what if you made no payments at all until the loan's maturity date when the whole thing comes due? There's no rule saying it can't happen if the seller's willing to agree to it. Or what if you made no payments until the property was generating enough revenue for you to make those payments? This might make sense if somebody was selling a piece of real estate with a business because that business is going to generate cash flow and maybe you need a little bit of time to actually get that cash flow coming in. Or what if the seller agreed to a 120-month or 10-year note with 0% interest in no payments until that maturity date in 10 years? With this arrangement, there would be no amortization at all because no payments would be required until the single final payment where you pay off the entire loan. Now, if you're at all familiar with normal financing, you probably already know these arrangements are very unusual, but depending on what kind of property you're buying and how long you plan to own it and how you expect to make a profit from it, it could be worth exploring this concept or some rendition of a non-amortizing loan that lets you keep your money in your pocket for a longer time without any interest. The seller may or may not be willing to entertain these terms, but there's no rule saying you can't broach the subject and explore what alternatives they might be open to. The bottom line is that if the seller is okay with waiting longer to receive the bulk of their money, it's usually in your best interest to hold onto your cash as long as possible, especially if it doesn't cost you anything extra to wait a little bit longer. Now, another way you can hook yourself up as the buyer in a seller finance deal is to do what's called a step-up interest rate plan. And most people think of a fixed interest rate as a static number that stays the same throughout the life of the loan. But there's actually another arrangement known as the step-up interest rate plan, where the interest rate can be set to change as the loan approaches its maturity date. So basically, as time goes on, the interest rate slowly creeps up and up. For example, the interest rate could change like this. It could be 0% in year 1. And then in year 2, it goes up to 2%. In year 3, it goes up to 4%. In year 4, it goes up to 6%. In year 5, it goes up to 8% and so on. So the further you go into the loan, the higher the interest rate gets. And the reason this can be so advantageous to you as the buyer is because this would allow you to pay no interest, or at least the least amount of interest, during the period of the loan amortization schedule when the interest is the most expensive. Because the way amortization works is the bulk of your interest is paid at the very beginning of the loan, and the bulk of your principal is paid at the very end of your loan. So if you can have low or no interest as early on in that schedule as possible, that's going to be a huge help for you. Better yet, if there's no prepayment penalty, you could pay down as much of the loan as possible during these earlier years so that when interest does kick in, you'll pay interest on a much lower balance. Another thing you'll want to keep in mind, it's really ideal if you cannot sign a personal guarantee. In some cases, you may have sellers or lenders who want you to sign a personal guarantee, which is basically like a written promise to find the money somewhere to pay off that loan. For example, maybe you would have to pledge your house or your car or cash in your bank account. When you sign a personal guarantee, it's going above and beyond and saying, I will find a way to pay this loan back no matter what. So if you sign a personal guarantee, that is great for the seller and lender, and it kind of puts you as the borrower on the hook a little bit more. But if you don't sign a personal guarantee, this ensures that if things don't go as planned and if you cannot pay down the loan as agreed, the seller's recourse does not extend beyond the project collateral, whatever that happens to be. It's usually just the project property. So in other words, your personal assets will remain out of the reach of the seller, which limits your risk to the investment itself. Of course, it would be unfortunate to lose the property after making whatever principal and interest payments you've made to date, but still, it is far better to lose only the property than have the lender come after your personal assets too. And in my opinion, this is one of the huge advantages of buying with seller financing as opposed to buying with a bank loan. If you purchase all your properties this way, there is technically no limit to how much real estate you can buy. Every normal bank is going to have an eventual limit where even if you're creditworthy, even if everything else still looks good, they just don't want to lend any more money to you because they don't want to have so many eggs in one basket with you as their borrower. So they'll just cut you off altogether when you hit that point. And that point is a little bit different for every bank, but they all have this limit. But if you buy every property with seller financing, and if each loan is its own little silo where the collateral of each loan is limited to just that subject property itself, you can basically buy an infinite number of properties. It's not going to be limited by some dollar amount because your loans are spread out all over the place among each of those respective sellers, provided your sellers will agree to this kind of arrangement. Now, on the flip side, if I'm selling a property with seller financing, there may be some unique cases where I might ask for a personal guarantee, but this usually isn't the starting point. When I'm buying a property with owner financing, I would avoid signing a personal guarantee unless there was simply no other way to get the deal done. Now, another thing you'll seriously want to consider including in your loan documents, if the seller will allow it, is called a partial release of collateral. And the whole idea behind this term is for the seller to release a corresponding portion of the subject property from their collateral pool as their borrower pays down the loan. So this kind of partial release arrangement makes a lot of sense when you're buying a portfolio of properties or a large parcel of land that can be subdivided so that the developer can sell off child parcels one at a time. And then when they sell those off, they can sell those properties free and clear because the seller/lender is agreeing to release their lien on that portion of the property that's being sold. In order for the seller to release a portion of the collateral like this, the collateral must be easily divisible. Now, if you're working in the subdividing game and buying the parent parcel with seller financing, including this provision in your loan documents is very important. You're definitely going to want to do this. At the same time, if you're ever buying a property with seller financing that requires a large down payment, whether the seller requires it or you just simply choose to put the money down, you could try to get a corresponding portion of the property released from the seller's collateral right then and there because you already own equity in a portion of the property. And if the seller agrees to this, you could take that released portion of the collateral, sell it at a higher price if you're a land flipper, and then recoup your entire down payment, maybe even more. So it's a pretty cool strategy. So one example of using this partially released collateral to cover your down payment is, let's say you buy a property that's 80 acres in size and you buy it for $80,000. And when you buy this thing, you put down a $20,000 down payment, which leaves you a $60,000 loan balance that you have to pay off. Well, because you put down that $20,000 down payment, you could have the seller release 20 of those 80 acres from the collateral pool. And then you can take that portion of land, the 20 acres, and resell it for, say, $30,000. So sell it for a higher per acre price than what you bought it for. And with that $30,000, it's more than enough to cover your entire $20,000 down payment and put an extra 10 grand in your pocket. So this is another pretty brilliant way to achieve a no money down deal because your down payment is reimbursed after that released collateral is sold. So it just goes to show there's definitely more than one way to skin a cat if you're trying to go for this no money down deal. Sometimes it just takes a little bit of creativity to make that happen. Now, Now, another thing you might consider if you want to get a little tricky is to split the loan into 2 notes when you're buying with seller financing. So most people assume that to close a seller finance deal, all the debt must be tied into a single note. And to be fair, this usually is how it works. But with seller financing, you could explore the idea of splitting that loan into 2 notes, with one note being in the first lien position and then the second note being in the second lien position. Now, why would we do this? What's the advantage of setting it up this way? Well, if you know how to arrange it, this could allow the seller to get a substantial cash down payment. But the key is, you won't have to fork over your own cash at closing. Let me explain a little bit. So let's say you're trying to buy a property for $100,000 and you want the seller to finance 100% of the purchase price through 2 separate notes. The first note, note number 1, is going to be in first lien position for 25% or $25,000 of the purchase price. The second note would be in second lien position for 75% or $75,000 of that $100,000 purchase price. So why would the seller agree to this and get all complicated like this? What's in it for them? Well, when you set up both notes this way, you can explain to the seller that once the transaction is closed and both notes are fully executed and everything is signed, you can help that seller find a note buyer so that they can sell that first note, the $25,000 one, to another investor. And once a note buyer is found, and preferably you'll be able to help them find this note buyer before the deal is even closed, the seller won't have to sit around and wait to collect this money from you. When this $25,000 note is sold to another note investor, that seller will receive approximately 80% of its value. Like I mentioned earlier, this is a common discount price when selling notes, is getting about 80% of whatever that loan balance is. So for a $25,000 note, that's $20,000 of cash they would receive in their pocket today instead of waiting for the loan to term out and mature, which could take many years to happen. So this gives the seller a 20% cash down payment. $20,000 is 20% of the original $100,000 sale price. So if you're following along with the math, this means that this seller basically has to take a $5,000 haircut on this deal. So that's something they'll have to be okay with, and you'll want to communicate this ahead of time, make sure they understand that. But if for some reason that's a deal killer, you could adjust the sale price upward and increase the amount of that first note just to offset that anticipated loss they would have to take when selling that note at a discount. And that's something you'd have to determine between you and them if that's worth it to you as the buyer to increase that loan amount. But however you structure it and whatever you have to do to get this seller on board with this idea, the key benefit is they get this $20,000 or 20% cash payout up front. And most importantly, the cash didn't come from you. It came from that note investor who you helped find for them. And when you connect a note seller with a note buyer, you could also potentially earn some fee income for brokering the deal. And just a side note, some states do require a broker's license to broker notes like this. And in this line of business, brokers will usually charge 1 to 2% of the sale price of that note, which is paid by the seller of the note with a minimum fee. So just be sure to check if a license is required in your state before you go down this road. But just keep in mind, this extra note brokering fee income, this is just extra icing on the cake. And it's not required to accomplish the main objective that we're talking about here, which is to get the seller paid with cash that isn't coming from you. Now, keep in mind, this doesn't change the fact that you still owe the full $25,000 for note number 1. You're just going to be paying it to this new note investor now. So this maneuver didn't erase any debt for you, but it did allow the seller to get a 20% down payment in cash. And most importantly, you didn't need to come up with that cash. Pretty cool, huh? This is a great strategy to help the seller get the cash down payment they want, even when you don't have the cash available to cover it. Now, the next thing to think about when setting up your loan documents when you're buying a property with seller financing is to set up an assignable, assumable, and wrappable security agreement. So what am I talking about when I say this? Well, in every seller finance deal, there is a note and there is a security agreement, 2 documents. Both documents are crucial, but they serve different purposes and they contain different information. The note focuses on the financial aspects of the loan, such as the loan amount, the interest rate, the repayment schedule, and the maturity date. And this is essentially a promise to pay under the agreed upon terms, but it doesn't include the protective clauses and details about the property that the security agreement does. It doesn't actually give that lender any power to go and seize the asset. It's just talking about the financial aspects and the promise that that borrower is making to pay off that loan. On the other hand, the security agreement, the second document, is the enforcement document that gives the lender the right to go in and seize specific assets if the borrower stops paying. And in real estate, the security agreement is usually either a mortgage or a deed of trust. And they're both a very similar kind of document. And whether it's a mortgage or a deed of trust, it usually includes information like the loan amount, and this figure should match exactly what is detailed in the note, ensuring total consistency between both documents in the transaction. You're also going to find the address and the legal description of the property in this mortgage or deed of trust. And there's also the terms of the security interest. So it outlines the lender's rights to the property if the borrower defaults on the loan, and it outlines the process of foreclosure or for taking possession of the property if the lender ever needs to do that. And there are also covenants in this mortgage or deed of trust. These are legally binding promises or conditions that the borrower agrees to abide by as part of the agreement. And they can be affirmative actions the borrower must take, like, the borrower has to maintain the property and pay the property taxes and insurance on time, or they could be negative actions that the borrower can't do, like altering the property in a way that could reduce its value or taking out additional loans secured against the property, that kind of thing. So it just spells out all these promises that the borrower is agreeing to when they take on this loan. And when you draft a security agreement, or again, a mortgage or a deed of trust, it can be a huge help if this document is made to be assignable, assumable, and wrappable. So what do these three words even mean? Okay, first of all, assignable. This is when a mortgage or deed of trust or any other kind of security agreement allows the lender, which is the note holder, to transfer their rights and obligations under this agreement to another party. So in other words, it allows the lender to sell the note to another investor. And this allows them to liquidate the note for cash before the term of the note is up, which offers that lender a little bit of liquidity and the ability to reinvest in other opportunities. So do you remember back when we discussed this idea of breaking up the loan into two notes, or giving you as the borrower the first right of refusal to buy your own note? Well, an assignment clause on the note is what will allow the seller to sell a note like this. So when you set it up like this, it really is in both the seller's and the borrower's best interest, because it gives you both the flexibility, especially if you have that first right of refusal to buy that note, and or if you're going into this with a plan of getting that first position note sold like we just talked about, so that you can get into this thing with no money down. So next up is assumable. What does this assumable word mean? Well, if a note or mortgage or deed of trust is assumable, that means a different buyer can step in and take over, hence the word assume, the remaining payments on the loan under the same terms and conditions as the original buyer/borrower without having to secure a new loan. And this is particularly appealing in an environment where interest rates are rising, because it allows a new buyer to step in and buy this subject property and benefit from having the original financing terms that you signed up for as the borrower when you bought this property. And from a buyer or borrower's perspective, this gives you another potential option to dispose of or sell this property in the future, especially if the financing terms of your seller finance purchase are just all around a lot better than what banks are offering borrowers in the future, and they probably will be. This will make the property and its financing package look far more appealing if you ever need to try to sell this property before paying off a loan. It just gives you another option to make it even easier for the next guy or girl who buys this property. And this last word, wrappable. What are we talking about with that? Well, a wraparound mortgage is useful when buying a property with owner financing, especially when the seller already has an existing loan in place. So let's say you're buying a house and the seller agrees to sell that house to you with owner financing, but they still owe money to the bank. They owe, let's say, $50,000 on their bank loan. And in this situation, that $50,000 bank loan would have a superior or first lien position. So in other words, if there were, say, 2 or 3 lenders who all had a claim to this same property, say the borrower has a few different loans on there, whichever lender is in first lien position, they are the one that has the first shot at taking the property as their collateral to satisfy their loan amount before any other lender does. These other lenders could also have mortgages on the property, but if they're not in first position, they have to wait in line until that first lender takes the collateral to make themselves whole. So first lien position is the safest and most secure spot for the lender to be in. Now, let's say this seller with the $50,000 bank loan gives you, as the buyer, a new loan to buy their house from them. So this loan can be structured to wrap around the seller's existing loan with the bank. This means that as you pay the seller is agreeing to use part of that money to pay their mortgage to the bank for their $50,000 loan, and whatever's left over from that, they can keep. Now, the seller would probably be doing this anyway, because as long as they still owe money to the bank, they'll have to keep making their payments all the same, regardless of what else they're doing in the background. But when you make a mortgage or a deed of trust wrappable like this, it just ensures, in case there was any confusion about it, that everyone knows how the payments should work. So it clarifies that the buyer, that's you, that you know that you're making payments to the seller, not directly to the bank, and it can provide some legal protection for both the buyer and the seller to make sure the seller uses the payments to keep their mortgage with the bank up to date. And depending on how you write this wraparound mortgage clause, let's say a few years go by and the seller pays off that $50,000 loan with the bank. Now the only loan that remains is the loan that you have with the seller. But let's say you want to now sell this property to somebody else. Well, with this wraparound clause, again, if it's written right, it could basically allow you to then resell this property with seller financing yourself and do the same thing, where you take that new buyer's payments and make sure that you apply an appropriate amount from those payments to the previous seller finance loan to make sure you're keeping that original lender satisfied, and then whatever's left over from that, if anything, you can keep for yourself. So it basically allows for this arbitrage situation so that there is no due on sale clause. As long as you continue making your payments to the seller for that seller finance loan, there's no rule saying that you can't sell it with seller financing yourself to another person. So making a security agreement wrappable allows for this kind of arrangement, which provides a lot of flexibility to structure deals that can benefit both the buyer and the seller. So there you go. Those are some ideas that you should consider whenever you're trying to buy a property with seller financing. Like I said earlier, a lot of this stuff is very unconventional. This is stuff that not every closing agent or title company is going to be familiar with. So you want to be sure you get this drafted by an attorney who understands what you're trying to do, and use whatever title company your attorney recommends to eliminate any confusion. And also, don't expect the seller to accept all this stuff. Some of the stuff is kind of out there, but very advantageous when you know when and how to use it. And it might be asking a lot to get them to agree to all of this stuff, but if you can get them to agree to any of it, it will be a huge help to you. So thanks again for listening, and I'll talk to you again soon.